Good. Well, welcome to today's edition. My name is Fred. You can call me Targets. Good. I'll be your tutor for the day in financial reporting and other subjects. Kindly subscribe to our YouTube channels and then like our page on Facebook. Then you can also watch us live there and then the YouTube live too. Good. You can also request for your one-on-one tuitions on all subjects or areas, and then we would deliver it to you. Thank you for watching us. Good. In today's lecture, we are going to talk about conceptual and regulatory framework of financial reporting, like the basic concepts and regulations in financial reporting. Good. Now, before that, let me just walk you through the real meaning of financial reporting. Good. So be with me now. Now, before I do that, we have to go through the stages in accounting. Good. So that you appreciate your paper well, the financial reporting. You will appreciate it well. Good. Now, the first stage of accounting, normally we call it financial accounting. Financial accounting. Good. Then the second stage will be called financial reporting. Good. And lastly, the corporate reporting. The corporate reporting, ACCA calls it strategic business reporting. Good. As SBR. So take notes. Now, when we mention financial accounting, what are we talking about and what are we saying in financial accounting? So as the name suggests, accounting, account for the transactions. So here we basically means record keeping. So records keeping. So at the end of the financial accounting paper, you should be able to know how to keep basic records or basic set of records. So that is it. Good. Now, financial accounting or financial accountants for record keeping probably starting from the recording of transaction to the posting, the double entry. That's the debit and credit entries in the books. So how to keep proper books of records, that's the financial accounting. So I believe anybody that's studying financial reporting have passed the financial accounting before. And even if you've not passed it, you'll probably learn it somewhere. That's why they based on it and exempted you. Good. So you should know how to keep basic records. Now let's graduate and or upgrade to financial reporting. Now financial reporting, the meaning, I'll just use two words to describe them. I'll use preparation and presentation of financial statement. Two words, preparation and presentation of financial statements. Good. So when somebody is preparing a financial statement and presenting it, that person is what? Reporting. Reporting on what? Financial. So that's the financial reporting. So thank you. So it means that after this paper, you should be able to know how to prepare basic set of financial statements. Oh yes, basic set of financial statements. Basic. So that is it. And then how do we prepare the financial statement on what records? The records kept by the financial accountant or the financial accountants. You pick it up, then you prepare or you summarize the records. You prepare the financial statement out of the records kept by the financial accountant. And you present it to the users, like the shareholders, for them to make informed decisions. Good. Then the last stage For accounting, it's the corporate reporting, a bit troublesome section. Yes, corporate reporting. As you can see, strategic business reporting. So it means that it's a strategic questions. It contains strategic questions. No. Yes, strategic questions. Now, for corporate reporting, it reports on corporate reporting, report on your financial. So it contains financial reports, and then integrated reporting, integrated reports. Good. And basically, the integrated report talks about the value added or value creation. So if I should start the whole thing again, the corporate reporting talks about the organization as a whole. So first, to talk about the financial reports, how to prepare them, and also talk about the integrated reporting, how the organization utilizes its resources to generate what? Value for shareholders. So that is it, value creating activities. How the organization creates value. That's integrated reports. And don't forget, the corporate reporting or the integrated reporting also talks about social justice and then environmental. So like you being equity, fairness, how you report on all this one. Then normally we use the triple bottom line reporting, which box on reporting of financial, reporting on your social equity, reporting on the environment. So take note, that's a corporate reporting. Good. Good. Now that you know that financial reporting is a preparation and presentation of financial statements, now let's go into it and study the very first topic in the financial reporting. Good. So now you know the meaning of financial reporting, to just prepare and present financial statements. So after this subject, you should be able to prepare financial statements. Oh yes. So the very first topic I will talk about it is the conceptual and regulatory framework of financial reporting. So conceptual and regulatory framework of financial reporting, FR. That's the first topic. Very lengthy topic. So basically, we are going to talk about concepts and probably some regulations of financial reporting. Yes. Now that we know that financial reporting simple means preparation and presentation of financial statements. Then, when you are going to prepare and present, what are the basic concepts or rules that you have to adhere to? So that is it. Now, be with me. Let's pick it one by one till we are done. So I'll pick the conceptual framework first, then talk about it. Conceptual framework of FR, that's financial reporting. Good. Financial reporting. Now, when you mention conceptual framework, we will talk about mainly it involves the principles, the assumptions, basis, the phenomenon that you have to adhere to when preparing and presenting financial statements. Okay. So basically, anywhere someone stands to probably mention financial reporting, the basic concept that comes to mind is the conceptual framework. Or the conceptual framework form the basis of financial reporting. So if you want to get a basis and if you want to report well, then the conceptual framework should be of guide to you. So like we said, like assumptions, principles, basis, phenomenon, tradition, customs that you have to adhere to, or that form the basis of what financial reporting. So when anybody wants to report, you have to make sure that you adhere to the principles in the financial reporting. So basically that is it. Good. So now you know that the conceptual frameworks contain principles that guide the preparation and presentation of financial statements. Now, these principles was given to us by a group of professionals called International Accounting Standard Board. They brought the conceptual framework, or they form it. So usually when we mention the conceptual framework, we say that the ISB conceptual framework. I hope you get that. So that is it. Good. Now let's see this. Well, so that is it. Now the International Accounting Standard Board, their main aim is to prepare and issue the IFRSs. That's the International Financial Reporting Standards. Good. And that's the sole aim. And they've also given us the conceptual framework. Good. That is it. So anytime we stand to talk about conceptual framework, we give reference to the International Accounting Standard Board. So take note. Now, I call this grandpa. Why grandpa? Because it's a sort of principal bank. So principal bank. Oh yes. Principal bank or knowledge bank. Then these IFRSs are the forms of rules that guide the preparation and presentation of financial statements. So these are specific rules, and these are the principles. So they are different. They are different. In fact, the conceptual framework itself is not a standard. No, conceptual framework is not a standard, but it's a principle. Yes, on which these IFRSs were based. Anytime you want to talk about IFRS or want to talk about financial reporting, the conceptual framework should be given a reference to or a form basis. Good. But anytime there's a requirement of a IFRS, probably conflict with the requirement of conceptual framework, the requirement of IFRS rule over the requirement of the conceptual framework. So that is it. Good. So now we know about conceptual framework. Now let's look at the purpose of the conceptual framework. The purpose of the conceptual framework. Purpose, or let's make it purposes of the conceptual framework. Conceptual framework of financial reporting. So the conceptual framework of financial reporting. Now the purposes, the objective, the reason behind this set of principles. Now the reason behind this set of principles, they are: one, probably to assist, oh yes, to assist the board, that's the IASB, in two ways. So to, one, assist them to develop IFRSs. Oh yes, IFRSs. That's all. IFRSs. So that's the first purpose, to assist the board to develop IFRSs, whether new or to update existing ones. So when you're going to develop new IFRSs or the future IFRSs, they need a conceptual framework. And then they are going to upgrade or update existing standards too, they also need a conceptual framework. So that's the first purpose to the board. Then we can also talk about promote international harmonization of the IFRSs. Wow. So promote international harmonization of IFRSs. Good. So the conceptual framework limits the alternative treatment of accounting transactions and makes the IFRSs, or gives the IFRSs, a standardized way of treating transactions. So in so doing, there's a level of standardization which has helped a lot of countries, a lot of member states or institutions in adopt the IFRSs. So the conceptual framework has helped the board to promote the good news about the IFRSs by restricting the alternative treatment. So the treatment that's stipulated or the treatment that is in the IFRSs should be the acceptable or the standardized way. So that is it. Good. Then we also have the other purpose. So let's talk about the other purpose aside the one to the board. Let's talk about the other purpose. So the other purpose, let me take the top section off. So take notes. Aside the two, now let's list these people down. The users of the conceptual framework. The users of the conceptual framework. They are, so the B, we've seen A, to assess the board, and B, it assesses the following. So here to assess, oh yes, to assess the following, bodies. To assess the following. Good. Let me underline it. The first person on the list is national standard setting bodies. Wow. Oh yes. National standard setting bodies. What are they? Each and every country have its own national standard setters. Oh yes, Ghana, we have. Then we can also talk about the users of financial information. Can also talk about the preparers. Wow. Those who prepare the accounts. So the preparers. Lastly, I'll talk about the auditors. Those who audit the account. So that is it. Good. So auditors. So what will be the purpose of the conceptual framework to these bodies or these people? So how will the conceptual framework help the national standards setting bodies? Okay, probably they set standard for their various countries, right? Okay, so they will use the conceptual framework as what? Benchmark. So to help them to develop the national standards. Oh yes, so at least to give a guide way or the roadmap. So take note. What about users? Users of financial information, the owners, and then the employees, and then the other ones. What do you think? It will also assist them, assist the users to interpret the financial statement. And before they can interpret what they do, they have to understand the financial statement prepared. And then they will interpret it and based on it and make what? Informed decision. So I hope you get that. Good. So that is it. So the users can think of employee, shareholder. Let's think of investment. Investors, sorry. When you pick investors, with the investor, When a financial statement is being prepared, you have to probably analyze it and then understand it so that you can make decision whether to continue investing or to withdraw its investment. And before you can understand the financial statement well and interpret it well, you have to also probably understand the conceptual framework. So that's it. Now the preparers, the accountants, the CFOs, the consultants, those that prepare the financial statement. If you're preparing, it will assist them to prepare the financial statement. If there's any requirement or there's any transaction that its treatment become an issue, you have to pause. I'm going to refer from the conceptual framework. Good. My friends auditors. Yes, I hope you are there. Good. Now, auditors, what do you think will be the purpose of the conceptual framework to auditors? Well, it will help them to form their audit opinion, because when the auditors come around, they are going to make sure, or they're going to detect, or they are in to make sure that whatever rules that guide you, you have adhered to, and then your account are clean, or your account represent true and fair view of your stand. So before auditors can say that your account is true and fair view, there should be a benchmark, or there should be a law that they will look at that law and look at what you have done. So before auditors can issue the audit report, they have to probably consult their conceptual framework to get some bit of understanding and see whether what you have done corresponds with what, or what you have done is in the same line with the conceptual framework. So that's it. So now let me ask you a question. What if there was no conceptual framework? So what would the auditors base their judgment or their audit opinion on? So that is it. Because there's an adage that states that where there's no law and there's no crime. So take notes. Good. So these are the purposes of the conceptual framework. So the purpose or the objective can also be the importance or the uses, depending on how you state your point or how you argue your point. So take notes for me. That's the purpose of the conceptual framework. Good. Now that I'm done with purpose, objective, uses, importance of conceptual framework. Now let me talk about the limitations or the challenges that we have with the conceptual framework. The challenges with the conceptual framework. So let's talk about the limitations. The limitations of the conceptual framework. Of financial reporting. So what do you think will be the challenge or the limitations of this conceptual framework? Now, the very first one, I'll give you a few, maximum of 3. The very first one that we'll talk about it will be wide range of users. So first, wide range of users. Yes. In fact, there are so many users to financial information. The users are many. So you can give an example. Examples are the shareholders, the management, investors, employees, suppliers, loan creditors, bankers, trade contacts, government authorities, and then other agencies. All of these have a different needs. All of these have a different interest. So one single or just a single set of rules or principles cannot guide all these people. Why? Because what they need is different. Pick an owner. Owner wants profitability and return. Oh yes, an investor. Then pick an employee. Employee that doesn't need profitability, because you take some. What employee need is what? Increase in wages and salary and job security. So think about that. So that's it. So wide range of users. So it means that Their conceptual framework provide only general needs. It does not provide a specific need of the users. Yes, because there are wide range and wide needs. So one set of principles cannot guide all the needs. So that's my first point. Good news. Let me go to the second point. The second point, I will talk about unique transactions. Unique transactions. So unique transactions. Here, the conceptual framework or this set of principles guides what has actually happened or what they think can occur or will occur has occurred like that. So that's the conceptual framework. But transaction can occur today, which is different or unique from the past transaction. There's no trend and there's no evidence. So their conceptual framework may be limited to govern it because there's no past dealing or it has never occurred before. Yes, and then no one thought it will occur. So that is the unique transactions. My third point will be, now when businesses when the business grows and expand and become complexes, yes, their activities or operations become so sophisticated, the old principle may no longer apply when businesses become complex. So the old principles may not applied or may not be applied when business become complex. Good. So when business become complex, the old principle can no longer apply. Yes, can no longer apply. Now let me give you an example. Assuming we are small, operating only in one part or one region of Accra, but now we are in the whole country, but the whole Africa, and now we are operating all over the world. All over the world. Good. So do you think the principle that we were using or the principle that we're guiding or guided by when we were young, will it still hold now that our transactions are complex? Our business risks has increased and then our capacity has expanded and increased. So that's the point. So let me give you two real life examples. First one will be, seeing that when everybody is young in the house, that person probably provide or do the house chores. Yes. When you are young, good. Most of the house chores be performed by you. Good. Now, when you probably grow up and then get married and probably visit your mom, can your mom tell you to go back and go and wash the bowls at the kitchen without any difficulty? Mom can just wash your face, go and wash the bowls before coming to talk to me. Yes. Why? Why? Why can't she do that? Yes, she can't do that because now your transactions are complex. Yes, because you're married. So that is it. But if your mom can still order you to go and wash the bowl and you go and wash, it means that your transactions are all simple. Oh yes, your transactions are simple. Probably she's the one feeding you, buying for you, taking care of your accommodation. So she can also demand some level of sacrifice for her. So that is it. That's the first example I'll give you. Good. Now the second real life example will be this. Assuming a house, you tell your kids that after eating, they should wash the bowls. No one should eat, then left the bowl unwashed. Yeah. And then there was one kid who was very sick. He cannot even walk. And you are the one that fed him. Then afterwards, do you expect him to go and wash the bowls? No. But that's the principle in a house. Now the transaction is complex. Now the transaction is what? Complex. The old principle can no longer what? Apply. Now look at the era of coronavirus. Oh yes. The old principle cannot work now. No. Most countries are in lockdown situations. So the old principles can no longer apply in this situation because this situation is what? Complex or unique. Thank you. There's no principle for coronavirus. So it's a clear example for you. Thank you. So these are some of the few limitations that or challenges that we have with the conceptual framework. Now be with me. Let's proceed. Good. Now that we know the purpose and then the limitation of a conceptual framework, now let's go to the actual content. Now with a conceptual framework, it's just like a report, notebooks, or a handout prepared by the board in which they've stipulated the principles. So now let's go and look for the actual principles in the conceptual framework. So probably we'll call it content. The content of the conceptual framework. We're now going to look at the contents. Yes, and the content number 1 talks about the objective of the financial statement. Objective of what? Financial statement. So financial statement. Financial statement. Good. Now tell me, what do you think companies spend time, energy, resources to prepare the financial statement? So what is your objective? Yes. Well, you know, he said that the financial reporting is what? Preparation and presentation of financial statement. So before you prepare the financial statement, what's the objective behind the preparation? Or other companies are preparing, that's what you are preparing. No, there should be a reason. So what was the objective behind the preparation? Good. Now, don't tell me it's for performance. No. Because for performance, your local market woman does not prepare financial statements. But call her, she can tell you her performance right from the day one that he started the account to that date. No records, no books. Oh, yes. Because of the ancient way of what? Measuring performance. Oh, yes. Before books and then medium of records come into play, how is they recording performance or measuring performance? Good. So now tell me the objective of financial statements. Why do entity have to prepare financial statements? Good. So think through. Okay. Now the objective for the preparation and presentation is, I mentioned, sometimes the ownership. The ownership and management are in different hands. You form your company, somebody is managing for you. So you don't know what is going on. So what do? So the management team have to convey or have to provide some sort of information to you. So how we get that? So let me take that part again. Good. Let me take it again. The network was warring. Good. So where ownership and management are in different hands, the management team have to convey information to the owner. That's it. So the main purpose or the main objective of financial statement is to provide information to the users. So now if you own the business, you manage it, then you don't need to prepare any financial statement. That the local market woman. Oh yes, she don't have any accountability role to play to the other users because she owns it and she manages it by herself. So that is it. So now let's go to the board. Let's come here. He said that so the objective is to what? To provide information. Provide information about what? To provide information about the company. Good. So that is that. Good. So to provide information about the company or the entity. About the entity. Okay. So that's all. So that's the main aim for preparing financial statements. For the one that owing, then that is it. Good. Now, for the market woman or the local traders, they don't prepare the financial statements because they don't need to provide information to anybody. Oh yes, he cannot deceive himself. He can't lie to himself, yes, or herself. So that's why there's no need for any financial statements, except for probably we're going to pick up a loan or go for advance from a bank, and then maybe the bank may request for your financial statement, and then they will go and fall on the consultant to prepare for them, and then they will go in for the loan. It's because of the loan, that's why they prepare it. So take note. But for companies, whether you're going for loan or not, you have to prepare. Why? To send information to the users. So to provide information about the entity towards to the users. So that's an underlined word. Provide information to the users. So that is it. Good. So take notes for me. Okay. Now, what are the specific information are you going to tell them? So the information I'm going to tell them are, so the specific information. One, tell them about the company's performance because they are not here with you. Assuming that company operating in Ghana, but the owners are in South Africa. So imagine, so the management team have to convey information to the owners in South Africa. They are not here seeing your performance. Even if they can see it on news, they've not seen it. Oh yes. They want official information, not hearsay. Good. So one, to provide information about the performance of the organization. So what financial statement will provide a performance? That's your profit or loss. So your profit or loss statement will explain your performance. Good news. So you get it now. Then you go to the second statement or the second specific information that must be provided. That is what? Your statement of what? Your financial position. Let me clean the statement and start straightforward. Oh yes, so your financial position. Your financial position. So tell them your position, the assets that you have, the liability or the claims that you have to settle, and then the equity balances. So that's the financial position. Then third information that they want to know is about the changes in their equity or movement in their equity. Changes in equity. Oh yes. Changes in owner's capital. Yes. At the start of the year, they were having 1,000 Ghana cedis there. Is it the same at the end of the year? Tell them if they are the same. Maybe transaction events occur. Will it have impact or affect their equity? Will the equity change with respect to the transactions happened this year? That is it. So that's changes in equity. And you know the statement, right? This is the financial position or the balance sheets, and the changes in equity or the income surplus. So we'll probably explain that. Then the fourth one that we will talk about it is, don't forget to tell them the cash flow position. Cash what? Cash flow position. Yes, cash flow position. Yes. So tell them the movement of cash in and out of the organization. So the whole year, the total cash received, and the whole year, the total cash paid. That's it. So that's the cash flow movement. Usually, let's see. If probably you are an accountant to someone who don't understand probably, who don't probably appreciate the basic terminologies in financial accounting, and you prepare your profit and loss statement and you earn a profit of 50,000. So the owner or the boss called you. So that was the profit. Boss, 50,000 cedis. Wow. Oh, this small company has made a profit of 50,000. Oh, then we are doing well. We are doing well. Then, Mr. Accountant, please, what is the cash balance? The accountant say 10,000. Hey, instantly you ask you, please, where is the 40,000 pass? Where is the remaining 40,000? Yes. So to explain yourself, you can't say that, boss, we bought this so much, we paid this. Explain it in a cash flow position. List all your cash transactions, your cash payment, cash receipts, group them nicely in a cash flow statement, and you will explain it. So basically, these are the information that you have to convey to the users. That's what they want to know. Oh yes, because we can't just send the book or scan all our books and forward to them. No, it becomes useless. They can't pick the relevant information out of it. So that is it. Now take note. Now these are examinable part of financial reporting. You cannot write any financial reporting paper without this for 20 solid mark. So the set is like this. The first 3 is one set. That's the profit and loss up to changes in equity is one set. So this can be for 20 marks. Then the cash flow alone too can also go for 20 marks. So 2 sets of questions in here, because we said that the financial reporting simple means preparation and presentation of financial statements. Thank you. Now we did mention that you have to provide information. So how many times do you have to provide such information? Or how many times do you have to prepare a financial statement? Now tell me, how many times? Is it twice a year, or once a year, or 4 times, or 3 times? How many times do you have to prepare financial statement? Well, basically, you have to prepare financial statement at least once a year. So at least, the line word is what? At least. The least one should be what? Once a year. Once a year. That's for continuous company. That's if you come to Ghana's company's code. But if you're a fresh company, usually 18 months. Within 18 months, you can prepare financial statement. So you have 18 months to prepare financial statement. Good. Now, at least once a year, let's do something here, some analysis here. At least once a year. So it means that my company can prepare, okay, the normal once a year, or 2 times, or 3 times, or 4 times, 10, 20. Okay, continue and be preparing as if there's no cost to it. The more you prepare, the more cost you will incur. Oh yes, why? First, preparation cost, auditing cost, and publishing cost. The press, the newspapers, front page. Good. So this is the strategies most companies have adopted. They will prepare final one at the year end, and then auditors will audit it and then publish that one. But in between time, probably quarterly, they will still have their quarterly report, but that one will not be audited and will not be published. They will just upload it on their website or the stock market. Why? Because if they should publish it, then auditors have to audit this. So imagine when auditors are coming around for 4 times in a year, or they're coming to audit you 4 times in a year. Imagine what will happen. When they're coming once, go look at the amount that they are charging you and then the expense that you are incurring. Now coming 4 times, oh, then they should come and join your company. And that's all. Oh, yeah, they join the company. So that's why. So to be prudent or to analyze the cost benefit well, then we have to prepare once a year, but you have to provide internal report or even, in fact, financial statement, but unaudited one and publish it. Thank you. Good, now let me move on to the users of financial information. I mentioned users. So the users, they are owners, shareholders, investors, but they mean the same thing. Yes, so in exam, take note, they are the same. Shareholders. I also talk about investors. They are the same soup. Oh, sorry, inventory. So investors, they are in the same soup, right? Good. So that is it. Okay. Now, also talk about management. Senior employee. Yes, senior employee. Yes. Let me talk about employees. Employees. Management team also employees, but they are senior. So take note. The fourth one that we are going to talk about is probably customers. Wow. And then the fifth one I'll talk about is suppliers. And then the sixth one I'll talk about it. In fact, these two are called trade contacts. Oh yes, trade contacts. Have you seen the contact on your phone? So people that you buy from or you sell to, so they are your trade contacts. Then the sixth one will be bankers. Oh yes, bankers or loan creditors. Loan creditors. Anybody that probably grant advance to you. Finally, our talks about government authorities or agencies. Government, on this right, Ghana government, no. Let me make it global. So the country that you are operating, so the government authorities. Good, such as what? EPA, Environmental Protection Authority, Ghana Standard Authority, Ghana Tourism Authority, in fact, all the authorities and then all the agencies. So you're done. Good. So now let's probably quickly run through what they need. All of these are the users of financial statements, and then they have a wide needs, different needs, like owners. If you form your company, what you need is not the same as what the employer also needs. It's not the same as the employees or the suppliers. So now let's see. Owners, shareholders, investors, all they need three items. One, they want the profitability. Yes, are you making profit this year? So when you give them information, they'll go straight and go and read the profitability level of the organization, and it ends there. Good. Then we talk about return. After knowing their profit, they also know their return. And then finally, the viability of their investment. Is their investment expanding, growing? Formerly, they started at just operating one country. Now they're in many countries. So that's the viable. Yeah, I see that's been viable. Now, management team, they want to know profitability because easy to decide or make decisions for the organization or to measure the overall performance of the organization. Oh yes, in their cost of what? Cost of management or in their period of management. Like for the 4 year, the term of office, term of management, what is the impact that they've made in the organization? Employees want three items. One, increase in wages and salary. Three, job securities. And four, continuity of the business, job security. Are they going to sack them? Redundancy to affect their position as the employees. Customers want two things. Are you going to provide quality products or services at what? Reasonable or affordable prices, and your continuity, because probably they've got some strong taste for your products. So if you're not there, they cannot survive, or they'll have some challenges. Suppliers, two things. One, suppliers want to make sure that as and when they supply the goods to you, you can pay them on time, or you can be or keep within all the terms and conditions. So that's the one thing they know. And the second, they also want your continuity. Probably you are their major customer. If you're not there, they are not there. So always they will pray for you so that you exist, so that you buy their goods bunch. Bankers or loan creditors, those are giving loans to you. They also want to know whether you can pay back the loan before they can probably grant additional one to you. And also keep within the interest payment and then the other terms of condition. Government agents, authorities, such as what tax authorities, they will base on the financial statement prepared to be able to determine your tax payable or your tax liabilities. And then the other agents to know whether you're complying with the state laws or regulation. Good. I'm done with the content number 1 into detail. Now let's go to content 2. Let's go to content 2. So the second content talks about the underlying assumption. The underlying assumption. Underlining assumption. So underlining assumption, or the assumptions of financial reporting. In fact, this topic is the one that at the financial accounting level, we call it the accounting concept. There are over 25 of them, or 20 of them, like prudence, going concern. There are so many accounting concepts. But how many or which of them have they underlined it? Have they accepted it or signed that this is the one that we should use? As God have what? Underlined Jesus Christ to be his beloved son. Have you seen? So the same way, out of the principles that we have, which of them should you pay maximum attention to? And with that, you can prepare a financial statement. That is it. So the first one I'll look at it is the going concern. Going concern basis. That's the one I'll talk about it. What's the meaning of going concern basis? Going concern. That's auditor's language. Now let us also be auditors for today. Okay. Thank you. When you ask, that I first said you're going to be auditors today. Now going concern simple means the business or the company will operate for more than one accounting year. That's all. Or the organizations or the company will continue its operation for foreseeable future. So the business is not going to collapse now. We live to see the future. Oh yes, we live to see the future. So the business will continue its operational existence for foreseeable future. Yes, we live to see tomorrow. So tomorrow is there for us. That's a going concern. Now, if somebody, yes, insult you that your going concern is in doubt, then gather everybody and then let it go and then ask him, because Fatih has really, really insulted you. Because your going concern is in doubt. Yes. Meaning, you don't know whether you're going to survive for tomorrow or in this coronavirus. Yes. Many are surviving, many are not surviving. So that's a going concern basis. Now, it suggests that as an accountant or incoming accountant or incoming financial reporter, when you're preparing the financial statement, make sure that, or you have to assume that the entity will live to see tomorrow, or the entity will continue its operation for more than one accounting period. So what do? So that's why we balance all the account, we balance it off and push it forward for next year. So because of going concern, we have balance brought forward and balance carry forward. Let's carry it forward because we live to see the future. Please, if you know that you are going to collapse, then don't use going concept. Yes, don't use the going concern concept, because if you carry it forward, nobody will be there. Your business will not be there. And you don't have ghost company. So that is it. Now, if you know that, definitely you are going to collapse within the next 12 months, then you have to use the other concepts. But this, they've not aligned it. So the opposite of the going concern will be the breakup basis. Breakup basis or liquidated basis. Breakup. So that is it. So in your last year of operation, assuming that we set a company, you probably produce a certain product, a state product for 5 years to supply to the government for 5 years. And now we are in the last year, the 5th year. What do? It means that we are not going to survive next year because our object of business has come to a successful end. So that's the good news. So that one, when I prepare an account, use the breakup basis. Don't balance the account and send to the next period. No. So close all the accounts and then prepare it. So I am done with the going concern. Now let me go to the second one, accrual basis Now, accrual basis basically talks about how to record transaction, which type of transaction you should record. Normally, it pick a statement or its meaning from matching. So either we call it accrual or matching concept. Good. Accrual simple means the transaction should be recorded as and when they occur, not when cash is being received or not. So accrual. So as long as the transaction has occurred this year, please record it. Oh yes, record it. Even if the payment will be affected after 10 years, still record it because the transaction has what occurred. The sales has been made or the purchase has been made. Whether you pay for it or not, please record it. That's accrual. So because of this, I have a nice formula for you. I said that, okay, record or recognized. Record or recognized is equal to occurrence. Wow, occurrence. So as long as the transaction occur, we have to do what? Record it. So that is it. Good. So you get it well? Okay. Now, the opposite of the accrual is the cash basis. Cash basis. So with that, you only record the transaction if and only if there's a cash movement. If there's no cash, no recording. So that's the opposite. Good news. Now, anytime they ask you that what is the underlying assumption when a requesting for one, it's only what? The going concern. In fact, the truth of the matter is that the underlying assumption is what? The going concern. Accrual is a subset of going concern. Now let me explain this. Accrual means, we live to see the future, so let's sell on credit. Accrual means we can sell on credit and then whether we receive it or not, we should record it. Okay. But if you know that you don't live to see tomorrow or you don't live to see next year, will you sell and give credit up to next year? No. So if you know that your going concern is in doubt, don't even apply the accrual concept. So accrual is a subset of going concern. Yes. I brought it here for you to appreciate or understand it well for me. Good. So in exams, when they ask you, state or probably explain the underlying assumption. One, they're looking for going concern. Underlying assumptions, then you call the accrual basis. Yes. Please, these are not underlying assumptions. So take note, they are not underlying assumptions. They have not stamped it or accepted it that we should probably use it. So take note. Okay. Now, basically, on accrual concept, if maybe 2018, my total sales is 9,000. Cash component is 4,000. And then the credit component is what? 5,000. What will be the total sales will I record? Will it be the credit or the cash or the entire? If I'm using accrual basis, the total sales occurred during the year is what? 9,000. So I have to record 9,000, not the cash component nor the credit component. And rather accrued the credit component as what? Receivable in my books. Or accrued as receivable or payable. Yes, the part that you have not received or paid, accrue it in the books as what? Receivable or payable. That is it. But if you're using a cash basis, you only record this. So please have a nice example in the lecture notes or the handout. Please get it and then solve it for me and you'll be fine. Good. Okay, so thank you. I'm now on the content number 2, the underlying assumptions. The underlying assumptions. Let me go to the next content. The next content. The next content. The next content talks about the qualitative characteristics of financial statements. So, qualitative characteristics of financial statements. Sorry. of financial statements. So the financial statement that we have prepared, it should possess some qualities, some features, some attributes. What are they? Don't forget that we have the qualitative features and we have the quantitative. The quantitative are the figurative or the numbers in it, your profit, the value that you had. But aside the magnitude, the financial statement also contains some qualities. So what are they? For these qualities, we have grouped them into two. Fundamental qualities and then the enhancing. Good. So enhancing qualities. So that is it. Enhancing. Now the qualities, the fundamental qualities, there are only two. In fact, why do we say it's fundamental or root? But is the qualities or the attributes that make the financial statement what useful. So any feature that make the financial statement useful, you are called fundamental. So all the qualitative features, you have grouped them into two, fundamental and enhancing. Some make the financial statement useful, and the other one just enhance it or just brighten it. This one is the DS root to the financial statement. It makes the financial statement look good. So that's it. The first one I'll talk about it is faithful presentation. Faithful representation. Faithful presentation. Representation. Now let's talk about faithful presentation. That's the first one. Then the second one talks about relevance. Relevance. So let me start with the faithful presentation. Now, what do we mean by faithful presentation? Faithful representation. It suggests that the financial statement that we have prepared, in fact, it should represent what actually happened on the ground. Oh, yes. Not what we think will happen or what we thought should have been. No, what has actually happened. So we said that faithful presentation simply means the financial statement prepared should represent the economic reality of the entity. So let me talk about that one. It should represent what? The economic reality of the entity. The financial statement prepared should represent the economic reality. Oh yes, of the entity. So reality of the entity. So that is it. Or she will present the actual stand, what purported to be the actual stand of the entity, the true and fair view of the entity, but not manipulated figures, not cook figures, not assumptions. No. So that is it. Okay. To report faithfully, the transactions and events should be reported on substance, but not their form. So take note, should be reported on their what? Substance, but not the form. So it means that if I pick your financial statement and if stated assets, a particular asset like plant in your financial statement, then this plant should qualify to be plant before you can record it. If that's not qualified, you cannot record it. So all the items that in your financial statement should satisfy the recognition criteria before you can record it. Now let's see something here. Now be with me. Now to report faithfully, the following ingredients should be there. So I normally call it ingredients of what? Faithful presentation. Please don't go to the exam now because I may not be there with you when it's marking you down. We call it ingredients. Or to report faithfully, the following items should be there. One. So you have one here. So that will be A. So the financial statement should be what? Complete. Oh yes, it should be complete. The financial statement should be complete so that you can report faithfully. Don't report on some of the items and leave the other. Let me give you an example. Assume that we have 10 tracks. 10 tracks. And these 10 tracks, in fact, only 4 of them are in good state. 6 of them are in bad state. Good. Now, this is a true picture. If we should report on only on the 4, our financial statement will look good. But if we report on the 10, it will be worst. So this company decided to report on only 4. It didn't show off all the 10 vehicles or the 10 trucks. That's unfaithful because the information was incomplete. So the financial statement should contain all what's supposed to be in. Please put it inside. Don't hide it. No, don't hide it at all. Put it inside. So that's it. And then to represent faithfully must be complete. And then it must also be what? Neutral or unbiased. 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 So that's it. Should be neutral or unbiased. Neutral means it should be fair in selection of your accounting policy. Fair in selection of what? Accounting policy. So fair in selection of your accounting policies. Let me give an example. Some of the accountants or management, they will select an accounting policy that will favor their position. So assuming they want to report or they want to prepare the financial statement, they will select accounting policy that would overstate the profit because their fat bonus has been linked or tied to the profit. So they have to find ways of what? Blasting or overstating the profit so that they can get the fat bonus. So that is it. Now, to report faithfully, the financial statement should be free from all material errors. So free from all material errors. So free from all material errors. That's free from errors. Good. Here, I'm not saying you are an angel. No. I'm not saying you are an angel so that you don't make mistake. No. Some of the mistakes are what? Pardonable. And then some of the mistakes too are not what? Pardonable. So take notes. Yes. Now let's go to the last one. In fact, the last one is the master of all. It controls the faithful representation than any of these guys. To represent faithfully, the transaction should be reported on substance. Transaction should be reported on what? Substance, the content, but not the form. But not their what? Form. But not their form. So transaction should be reported on the substance, but not the form. So take notes. Now, as soon as I mention this, it boxes on to what you call substance over form. Substance over form. So substance over form. Now let me go and explain substance over form at the other section, okay? Can I probably claim the initial states? I can explain the substance over form here for you. Yes. Now be with me. Yes, be with me. And don't forget to subscribe and then tap on the notification button. Oh yes, so that you get access to all our videos. Good. Now substance over the form. Substance over form. Wow. It's a very topical issue, substance over form. Now, substance over form means that some of the transactions, there are two sides of every transaction. In fact, not the debit and credit. If I should add debit and credit, it become what? 4. Oh, yes. 4. The debit and credit is the entry. The two entries, debit and credit. But if I'm talking about sides, if I'm talking about the form, sides, the form, each and every transaction have two sides. One, the sides are the legal and then the form. The legal is the same as what? The form. So now before I define substance over form, let me do some small illustration for you. So we have the legal form. Then we have the substance. I call it economic reality. Economic what? Reality. Yes. They'll tell you that Philip Agoji, right? Oh yeah, that's a local translation. Yes. Or substance. It's also called substance. Yes. It's also called the content. Oh yes, I call it content. Content. So that is the names. Now, each and every transaction that occur in accounting have two forms. Good. Now, each and every transaction have two forms. The legal form and the substance form. For the legal form, I normally call it what? Physical. Oh yes, physical. Please, that does not mean that the economics session is what? Spiritual. Please, don't record spiritual matters in accounting book. No, not at all. Not at all. I'm begging you. That is it. Okay. Now, let's assume that you walk to a shop and you buy something there, like you buy a book and you pay instantly. Let's analyze the size. Legally, oh yes, legally you own it. There's ownership. So what do? Okay, you can record it as what? Record as sales, no, as purchases when you buy. Then, economically, economic reality, the substance and the content. Who have the goods in possession? Who control the goods? It's you, right? So you control the book now. So now you can also record it as what? Purchases. Okay. Good. Now this one they have, so there's no difficulty. Both the legal and the substance is saying the same thing, so there's no issue here. But it's not the same for some of the transactions. Now let's see. Some of the transactions, their legal form or their physical state is different from the actual content. The actual content or the substance. Now let's give an example. Finance lease. Finance what? Lease. So finance lease. Finance lease is a transaction or situation where you want to use some asset, but you don't have the money to acquire it instantly. So what do? You rent it for a longer period. So that's a finance lease. That's the basic meaning of the finance lease. You rent it for what? A longer period. You're going to rent it. Now we are going to rent it. Let's put our legs in. Yes. Our legs in the shoes of what? The leasee. The one who's going to rent it. So now tell me, legally, is asset for us? No. No. Ownership. Wow. No what? Ownership. Okay. If there's no ownership, then don't record it. Don't record it. Okay. Don't worry. Let's see the economic reality. Now tell me, who controls the assets? Control. Who even use the assets? First, who control the assets? The one who uses the assets normally controls it. Now, where does the economic benefit move to? Economic benefit, where does it flow to? Economic benefit. Okay, we enjoy the economic benefits, right? Good. We enjoy the economic benefits. So in accounting, the one that enjoys the economic benefits have the right to record it. Assuming that the asset will last for 50 years, you are renting for 45 years. It will last for 50 years. We are renting for how many years? 45. So it means that we are going to even enjoy the asset longer than even the right owner, right? Not that we are the left owner. No. So that is it. So now, because we control, we can what? Record an asset. So we can record what? Assets. Here, don't record assets. Hey, there's trouble here. So there's a confusion. So what the legal form or the legal state of this transaction is materially different from what? the economic state. So now the truth of the matter is that whatever the substance, the economic reality, the content says should supersede or over the substance. So that's what we call it, the substance over form. So whatever this one says is the final, is the one that we are going to record in a book. So the requirement of the substance should supersede what? The legal form. So now let me define substance over form for you after this. Now, substance over form will be is a transaction or situation where the economic reality, to bracket the substance of a transaction, is materially different from the legal form or the legal state. In fact, in the books, you have to report or record on substance, but not the form. Please, if you want to record on the form, please go to the law court. When you go there, that one, report on legal issues there. Good. So that is it. Now, I'll give you 3 examples. Please try and end or try and add 2 to it. The next lecture, I'll pick them. So the next lecture, I'll probably come and then add a 2 to it. By then, you have get your 2. The next one is high pitches. High pitches. High pitches is where you high an item or equipment or plant or any items at all before you buy them. So you high and pitches. You high it now and pitches later. So what's the legal? It's also for the same link. No ownership. No ownership. In the period of the hiring, if you default, whatever you pay cleared or cancelled, then you come and then retrieve the asset from your premises. Oh yes, the asset does not belong to you. You come for the asset. Good. That is it. Now, what is the economic? Yes, it's also for the same line. We control the benefits move to us, so we can record it. So that's another example. Now, let me go to my third and my last example of the day. Third and last example of the day. Good. So example 3 will be sale and repurchase agreement. Sale and what? Repurchase agreements. Sales and repurchase agreements. Now let me illustrate the transaction to you. These are the transaction worker. We need 10,000 Ghana cedis. We need money. We need what? 10,000 Ghana cedis. Wow. Urgent. Immediately. Wow. To probably go and clear some goods from the port. And after clearing that goods, we will get 100,000 Ghana cedis as our profit. Oh, wow. Then we can just set off and then go. We can even get more than that. But we don't have the cash. But our customers too are waiting for us. What do? But we have a nice asset there, a valuable asset. A valuable asset. Now let's go and sell it. Probably the value of the assets can be higher than 10,000, but let's sell it for 10,000 so that to entice the buyer to buy it fast. So we call one of our customers. We have a very nice asset there. Will you buy? Also, yes. So we sell, or we sold it, or we are going to sell it for what? 10,000 Ghana cedis, and tell him that, okay, after 3 months, I'll buy it at 11,000. Let's make it 15,000 from you. I'll buy it what? 15,000. So sale and repurchase after 3 months. It's an agreement too. Okay. Then on a condition that please keep the asset for me. If you able to keep the asset well or kept the asset well, it should be like this. I will pay you 500 Ghana cedis per month. 500 Ghana cedis per month additionally. Okay. But if you know that you are going to use my assets, then please, I'll not pay the keeping fee of the 500. But make sure that the asset is in good condition before you return it in a 3 months' time. Please, this is an agreement because you can't go and do it to anybody on the streets. Then, no, it's an agreement. Good. So that is it. Now let us analyze the economic state, or the reality or the substance versus the form. Let me start with the legal form. Legal, is there any sale? Is there any sale here? Tell me if there's any sale. Oh yes, legally there's sale. Yes, there's sales, so they should record sales. There's what? Sales. Good. Why there's the reason is when you sell the item, you will transfer the title deeds to the person until what? The third month. So the title deeds will be transferred. Now let's see the economic reality. So physical or the actual content, the substance. Is it sale? Is there any sales? No sale. Because you can't sell something and after 3 months, you still have possession, or you still have it in your premises, or you still have it in your books. Why? Is it a magic? No. So here, no ownership. No what? Ownership, because we can't sell, sorry, no sale, not ownership. We cannot sell and still have it. So no sales. No sales. But if it's no sales, then it's what? Okay, you may be right too. Yes. It is loan. Oh yes. We went for loan. Went for 10,000, and then the redemption value or repayment amount is 15,000, and then interest of 500 monthly. So that is it. So we have to record it as what? As loan. So take note, in most of the exam question, we are going to record it as sales and put it in a transaction for you. And then we will inform you that this is how they've done it. So with the help of substance over form, you have to reverse whatever they've done and then do the right and record it as what? Loan. So reverse the sales that they've treated it and then do the writing as loan, because in reality, there's no sale, because you can't sell anything and still have it back. Okay, so thank you very much for being with me. Now, when we are done with this, that's the end of the substance over form, and that's the end of the faithful presentation. So be with me. In fact, unfortunately for us, this is how far the good Lord will bring us for today's edition. So follow up to the next standards or to the next ratio to pick the continuation of the conceptual framework. So thank you for being with us. But don't forget to subscribe to our YouTube channel and then like our Facebook page for us. Once again, my name is Fred. You can call me Target. Yeah. So see you when I see you again. Have a nice day. Bye.